The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Welcome to the Senior Show
with two wild
and aging guys. I'm your co-host, Neil Himmelstein, with
Tim Kennedy, your certified reverse mortgage professional.
And I have Main Street Planning Group, and we're an independent insurance wholesaler helping hundreds of agents across the United States and you, the client, with any type of life insurance, disability, long-term care, annuities, and life settlements for those who have this asset that they can't afford to pay for or don't need anymore and they want to sell it. So, which is a life insurance contract. People don't realize it's an asset.
It is an asset, yeah. So, people talk about their house all the time as an asset, obviously. Right. And I love going to parties and family events, and people talk about or they brag about how much equity they have in their home.
Right.
Which is, listen, that's phenomenal. But the point that they're missing is the equity in their home is an illiquid asset.
Yeah, it's interesting. I'd like to visualize a home. Wouldn't it be nice if the walls were made of dollar bills and I could just pull them off when I need it? When I could just pull them off. Here.
Right.
Hey, I need a new furnace. Let me just pull it off the wall.
So, Neil, I'm 61, right?
Yeah.
My wife and I are having these conversations now about, my daughter's getting married next week. My son is out of the house. My youngest one just signed a lease, so she'll be moving out of the house. She's getting her own apartment. And, my wife and I are having these conversations about what do we do with the house? When are we going to retire? When do we file for Social Security? All these different conversations. And if you think about it, it's very overwhelming. But if you take it piece by piece and kind of put it into a timeline, maybe it's a little bit more manageable.
Right.
But, as we retire, what are we looking for? We're looking for control.
Right.
We're looking for liquidity, right? We still need to be able to access money in retirement when we might be on a more of a fixed income. Right now, you and I have the luxury, if you want to call it a luxury, we get up every morning and go to work.
Right.
We have the ability and the willingness to make as much or as little money as we want on any given day.
Correct.
But when we retire, okay, that's it. Right, whatever we have saved, or what do we get from Social Security, or a pension, that's the limited amount of money that we have every day.
And that's a good point. And there were some studies I just read about. I think 47% of women, and it was about women for some reason, run out of money during retirement. Just run out, or couples run. Why? We're living longer.
Well, we're living longer, and probably during her biggest earning years, she may have been married and home raising the children.
Right. It's a difficult phenomenon. Running out of money is one of the biggest fears, and although we may have accumulated a bunch of assets, we don't think about that check that was coming in every week or every month or every 2 weeks, whatever. While we were working, there was that income source. And people tend to rely on, okay, well, I'm going to get Social Security. That's going to replace
Yeah, great.
But that doesn't replace my paycheck. It's a piece.
And Social Security was never meant to cover your mortgage payment.
Right.
Social Security was just something to supplement something when you retire.
So, unfortunately, the golden dream of, okay, that's going to be enough money for me, it's not. Plus, now we're kind of on a fixed income, even though it goes up with inflation a little bit, if that's what we're relying on. But our expenses keep going up and up and up and up. So that's why we run out of money, because we haven't accommodated for when that income flow is not working.
Yeah. I was speaking to a woman a while back, and she was in her 90s. Sitting at the table, and she was in tears because she was so disappointed in her and her husband that they didn't plan accordingly because she ran out of money.
Right.
And I said, Mrs. McGillicuddy, I said, you and your husband did not do anything wrong. I said, the only thing you did wrong is you're living too long.
Right.
And she, and thank God she had a sense of humor, and she laughed. She's like,
Right.
You're right. I said, yeah. I said, when you and your husband made your plan, that plan was based off of life expectancy. Your life expectancy at that time was probably somewhere in the mid-70s, and now you're in your mid-90s.
I had that same conversation the other day on a life insurance policy. They were paying all along. When they bought the policy, they only considered it, okay, it's going to go to I'm 90, right? And that was projected at 90 when they bought it.
Great plan.
Okay. But now they're 92. They still have it. But now they've dumped in all this money in it, and they're like, it's run out of money to the point where they got to put a ton more money into it if they want to keep it. So that's when sometimes we sell these policies to open up that liquidity.
Well, and Neil, that's why I have these conversations with financial advisors and financial planners and elder law attorneys, because we're ignoring a major piece of their retirement plan.
Oh, absolutely.
Home equity.
Right.
Housing wealth.
Right.
Being able to access the money.
No, it's key.
The equity in their homes that may have dissipated or mitigated that risk or loss of these people running out of money later on in life.
You got to count your chips, and it's very important. And planning doesn't stop when you're 50. It doesn't stop when you're 60. It doesn't stop when you're 70. Planning continually goes on, and as things change, as the environment changes, as we always say, are you ready for that next step? And sitting with us, and just sitting with an attorney, he's not going to have all the answers. He doesn't understand everything I know. He doesn't understand everything you know. Sitting with an accountant, he might be great at crunching numbers, but he doesn't know what I know. He doesn't know what you know. Sitting with you, an accountant, an attorney, and me, oh my God, I think we know pretty much, we can cover your bases. And that's the point. And the problem is, as I see it with a lot of people, is they have that one trusted advisor. That's
Uncle Billy?
Uncle Billy. Maybe it's their actual attorney who's done planning for them. But once they leave that office, they go, okay, we're good. Right? They'll buy a life insurance policy and go, okay, we're good. I got this. Let me put it in the drawer over here, and it's magically going to work later on, because I bought it.
Yeah.
I had the best salesman. It was the best company.
The best.
It was the cheapest. It was a this. It was a that. But you know what? Tell me about it in 10 years. Hey, what did you buy? Let me go find it.
Let me go look for it.
Oh, wait a minute. Maybe that was the best thing in the world you could have bought at that time, but it's 10 years later, and
you don't know.
Things change.
So I have an Uncle Billy. That's why I've referenced him. And
I thought it was Uncle Luigi or something.
Everybody has an Uncle Billy.
Okay.
Right? Like, for example, for me, I was having a house party, and, I got 50, 60 people in the house. It's total chaos. And Uncle Billy walks in, who's my godfather, by the way, and I love him dearly. And he comes in, he puts his arm around me, he goes, Tim, he says, don't tell me you're doing those reverse mortgage things where you're giving people money and you're stealing their houses. That's an Uncle Billy. It's furthest from the truth.
Right.
They maintain home ownership. It's just a mortgage.
Right.
The only difference between a reverse mortgage and a forward mortgage is when and how it gets paid back. Right now, you and I have mortgages. We make a payment on the first of the month. If we had reverse mortgages, we wouldn't be making payments, or we wouldn't be obligated to make payments. But that mortgage would get paid back when we left that home permanently.
Right. Or we can make payments.
You can make payments.
Or not.
Sure. Yeah. That's an option. It's an option. It's a payment option loan.
It's a payment option loan. So, which is great. And people use whole life for that as well. They'll have a whole life contract, and they'll go and they'll buy another house. They don't have to fill out any paperwork or anything. They just call up the company, give me a loan, and guess what? They can pay it back when they want, but they just have to pay it back at some point. Hopefully it's not at death, because it might deplete your contract, or it may be like, oh my God, I don't pay it. But you do have that option. It does accrue rate interest, like a reverse would. But for those that are young investors, I actually have a real estate group that contacted me to do a seminar on what they call infinite banking, because they're using these whole life policies to do that. And It's an interesting strategy, but all our things interact. They all, like I said in other programs, everything we do interacts with another professional. So it's very important to have your professionals work together.
Well, because it's all coming to a common good.
Right.
Again, getting back to the control, getting back to the liquidity, getting back to the legacy.
That's a good point.
Of the retirement. But each of them is a different piece coming in from a different angle.
Right.
That's going to secure, and potentially make your retirement that much more better, or the potential of your money lasting longer in retirement.
And your client is the Henry Ford of that Ford factory, and they have to realize it. They have to help put the pieces together, but they don't. We can help them, guide them in coordinating the right people. My goodness, the music has come on, and we're running out of time, Tim.
It's crazy how that happens, right?
It's crazy.
So, hey, my name is Tim Kennedy. I'm your certified reverse mortgage professional. If I said something today that piqued your interest, give me a call. 516-729-6040. 516-729-6040.
And this is Neil Himmelstein, Main Street Planning Group, and host of the Main Street Code for Financial Success. And my number is 631-647-4694. We'll be right back. Welcome back to the Senior Show with co-hosts Neil Himmelstein and Tim Kennedy. We are two
wild and aging guys.
Well, Tim, we were talking about retirement, and what I like to talk about is income sources at retirement.
Well, that's the whole idea.
Right. So where are my cash flows going to be? Maybe it's Social Security, maybe it's a pension, maybe it's my own investments, but what's the difference on where my cash flow comes from? And you could probably tell me the difference. It comes down to one word. Taxes. Okay, you didn't know the word. All right. You lost on that quiz.
I got lost on that one, yeah.
So when we look at retirement and we're planning for retirement, we look at not only how much money is coming in, but how much of it is taxable or non-taxable. And the reason is we have a partner in our retirement.
We do, Neil? Who is that? Who could that be?
That's Uncle Sam, not Uncle Billy, but Uncle Sam. Billy only gives commentary. Uncle Sam, he takes your money. So
listen, one of my classic lines, and you've heard it 1,000 times. Ed Slott says, even though we call him Uncle Sam,
yep,
he's really not our uncle.
No.
And there's really no reason why we need to give him all our money.
That's right. That's funny because Ed Slott and I had a long conversation years ago, about 30 years ago, and I'll never forget it because he was the stretch IRA king. I love Ed Slott. His TV show is beautiful. He's a brilliant guy. But I said stretch IRA, which no longer exists, by the way.
No longer exists, by the way.
They do have stretch non-qualified annuities, and they do have an IRA. You can only take it over 10 years now in most situations, which is no longer a stretch. And now all of a sudden, as I told him 30 years ago, you're forgetting about this thing called life insurance. Because life insurance has this very unique quality that you can take the money anytime you want, income tax free, and Uncle Sam is not involved. Isn't that crazy? Anytime you want. You don't have to wait till you're 59 and a half. You don't have to take it when you're 72. Anytime you want, or not at all. Leave it behind. Isn't that crazy?
There you go.
So it's another income source. And
but
what I'm saying
Ed Slott is a huge proponent of any type of financial product that limits the amount of money that goes to Uncle Sam.
That's the point. So now he's singing the song of life insurance, and it was always stretch IRA because he was in a CPA.
Well, he was singing the same song years ago about reverse mortgages. Oh, no, not a reverse mortgage.
Oh, really?
And then we educated him.
Oh, he changed his tune.
And he changed his tune. Why? Because it changed, Neil. It changed. And now he's a huge proponent of a reverse mortgage. Why? Because if you create the reverse mortgage line of credit, it has a guaranteed growth rate factor to it, so it increases over time.
Right.
So now instead of taking money
and you're not paying for it to increase.
And instead of taking money out of an account that's taxable, right? Now you can kind of go back and forth, take money out of my home, out of my equity in the house that's tax-free.
Right.
And if you coordinate this with the market and the equity in your home, you could actually leave a bigger legacy to your children. And have more cash flow in retirement.
Right. And tax-free life insurance, IRAs taxable, Roth IRAs not taxable income, life insurance not taxable, equity in your house not taxable. So all these different income flows, I'd rather have $1 million tax-free than $800,000 taxable. It's just that big a chunk of money that comes out. So when we're doing planning, either pre or post-retirement, taxes are our main consideration. Even though neither one of us are an accountant, taxes are so important. And tax planning is not just, I'll give you another situation. One of my callers called me last week, maybe 3 weeks ago. I'm sorry. We sat down twice, and she's doing very well, very successful. She owns a business. She owns a commercial property that's paid for. She has an income coming through. She has considerable amounts of IRA money that she's put away, and she has also some Roth money. She's done planning, good planner. But now she's thinking, and she's still working. She said, she's working and she owns this business on the side, both things. I mean, she's got a lot of income flows. But now she's thinking, what if I want to work less? Where am I going to get my income from? And how am I going to protect it? So there's a lot of moving parts.
Sure.
And we sat together. She asked me for a tax planning attorney. She went to an accountant. I'm sorry. She went to an estate planning attorney. He happens to be a radio show here as well, and started doing some estate planning. Then she came to me. I said the same thing the estate attorney did, even though her financial advisor advised her of something different, which is interesting. And now she went to a new accountant who she thought was a business accountant. And she said, I need an accountant that understands tax planning. But that's what we do. So although we're not accountants, tax planning is so important in integrating your different assets. If you're fortunate enough to have asset pools, we help you create them. But at the end of the day, how to spend your money in retirement is just as important as how to create your money for retirement. Wow, I didn't mean to be such a long soliloquy, but
breathe, Neil. Breathe. Take a breath. Take a breath.
I'm
Take
trying.
a breath.
You got to keep me going here. So, anyhow, what else is going on, Tim?
That's it. I got a big wedding this week.
That's exciting.
Yeah. So Friday, next Saturday, my daughter's getting married.
Oh, congratulations!
Out at Flower Fields in St. James.
Oh,
have you
awesome.
ever been there?
I have, yes.
It's gorgeous.
Gorgeous.
So my daughter was looking at...
Used to be Gyrodyne, right? Wasn't that a airplane factory?
It may have been. There may have been a facility off to the back in the back over there. Yeah.
That whole thing was airfields.
Yeah.
At one time.
So
long time ago.
She was looking for like a beach theme.
Okay.
And just didn't like them, couldn't find them. And she's coming home from West Hampton. I said, Dana, when you're coming home, why don't you just stop by Flower Fields, check it out? And she gave it, Dad, I want a beach theme. I said, well, could you just check it out? You're going to pass it on the way home. And she did. They loved it. They signed the contract. That was about a year and a half ago. And here we are.
Wow.
This wedding's breathing down our necks, So talk about change.
Change is, listen, change is going to happen whether you want it to change or not. Life changes.
I was helping my younger daughter this morning fill out her 401k deductions for her pay and her salaries and everything else, and I put my wife and I on as the beneficiaries.
Right.
And as I'm putting us in the beneficiaries, I said to Erica, now you have to remember that we did this.
Well, let me tell you something. Right now, I recommend young people putting it in a Roth 401k.
Right.
And the companies don't talk about it. Ask your company if they have a Roth.
Isn't there like an income level that it has to be at?
No, not at all.
Okay.
So Roth 401k is going to grow tax deferred. They'll still get a company contribution, just like they would on a regular 401k.
But it's not pre-tax, obviously. It's taxed and then put into the Roth.
Correct.
Yeah.
So why would you do that? Well, if you're just starting out in a job, you're not making killer money where you need to save on the taxes.
And she doesn't have all that much expenses right now.
What?
She doesn't have the expenses
Correct.
right now. Yeah.
So down the road, when she needs that money, let's look into the future. Mm-hmm. Wouldn't it be great to have $1 million tax-free, not $1 million taxable?
Right.
Because that's when she's going to be in a higher tax bracket. See, we were taught early on in life that when you retire, you're going to be in a lower tax bracket. Please,
and that's not the case.
Please tell me one person you know that's in a lower tax bracket at retirement than they were when they were working. It just doesn't happen because most of the assets we've developed have been poured into these IRAs and 401ks. Now's the time to start and talk to her about that.
Yes, that's a good point. Hey,
yes.
We should probably continue this conversation next week because that's a good point.
You got it.
All right, man. Hey, Tim Kennedy here. You're a certified reverse mortgage professional. There's something I said today that piqued your interest. You want to learn a little bit more? Give me a call, 516-729-6040. Or you can reach me at timtalksreverse.com. Neil?
And this is Neil Himmelstein. Best way to get a hold of me is 631-647-4694. Thank you for listening. Also listen to my other show, The Main Street Code for Financial Success, and we're here to help you with all your financial questions.
And Neil, who are we?
We're two wild and aging guys.